Welcome, everyone. I'm Joe Halwax, Senior Managing Director of Institutional Investment Services here at Wespath. I'm joined today by my colleague, Karen Manczko. Great to have you with us, Karen.
Thanks, Joe, and thank you to all of our institutional clients for your continued partnership. We truly appreciate it.
So, Karen, let's start with a hypothetical. Let's say that you went off to a peaceful, disconnected paradise on April 1 with no Wi-Fi, no connectivity, no headlines, and you came back on July 1. And you looked at your balanced stock and portfolio and you were thinking, this is a pretty quiet and steady quarter.
Mm-hmm. Well, that definitely would seem like the right conclusion based purely on the numbers, but we know that was not the case. The quarter was anything but quiet, packed with headlines that moved markets and dominated the news cycle. It kicked off with Liberation Day in April and the surprising scope of the Trump administration's new tariffs, and it ended with the U.S. bombing 3 nuclear sites in Iran. That's a lot of geopolitical and economic turbulence in just 90 days.
Absolutely. We've seen a constant stream of major developments, many with the potential to reshape global dynamics. The administration is simultaneously pursuing major shifts in trade, in tariffs, and immigration, with NATO, and in global power relationships. And any of these on its own would be significant, but tackling them all at once has created a lot of market noise. We talked about this in April in our blog, but markets seem to be getting more resilient amid this flood of headlines.
Resilience is a good theme. Back in April, equity markets saw sharp volatility. The S&P 500 dropped 20%, and Magnificent 7 tech stocks fell over 31%. But then came a stunning rebound in May, and those same tech giants posted record gains and strong earnings. The full equity drawdown was recovered in just 55 days, the fastest recovery from a 15% correction in the past 75 years.
That's amazing. Thanks for that update. Now let's shift and talk about fixed income macro drivers for a minute. What is the latest on growth and inflation?
So in the first quarter, U.S. GDP was slightly negative, but that was largely due to a front-loaded surge in imports as businesses tried to get ahead of the tariffs. The Atlanta Fed's GDP Now model is projecting a solid 2.6% growth for the second quarter, again, showing resilience despite some headwinds.
And what about inflation? So we expected some impact from the higher tariffs, moving from an average of 2.5% to what could be just over 12% later in 2025. But so far, inflation has not spiked as much as many expected.
Correct. Inflation is still elevated, but showing signs of moderation. The May Consumer Price Index was 2.4% year over year, and the Fed's preferred measure, the personal consumption expenditures, came in at 2.3%. Both are above the 2% target, but down from previous peaks. That's created a more supportive backdrop for bonds. So the Bloomberg Aggregate Index is up 4% year to date. There are some industry experts that expect inflation to increase in the fourth quarter, given the inflationary impacts of the tariffs being delayed due to retailers applying markups on their new inventories. Therefore, consumers would see prices increase. So with this being said, if we see an increase in Q4, this inflation could be sustained in early 2026 due to the impact of higher income tax refunds on consumer spending. Again, it's really hard to know for sure the inflation impact, but it's something we and our asset managers are monitoring.
And with that in mind, I want to make sure we talk about 2 other quick macro notes before we move on to performance. First, the Fed is now expected to cut rates by 50 basis points starting in September. That's a change from late Q1 where 0 cuts were expected due to stronger data and tariff uncertainty. And then secondly, the dollar has weakened. It's down 10% year to date after a strong Q1. It's partly due to long-awaited rotation out of U.S. assets and also some lack of confidence in the U.S. given the major policy changes, something we'll be keeping a close eye on. Let's switch gears and talk equities and performance.
So looking at the equities, we saw the internationals were the largest driver of the equity market performance, outperforming U.S. equities by more than 10%. The S&P 500 returned 10.9% in the second quarter and is now up 6.2% year to date. The MSCI ACWI ex-US jumped to 12.7% in the second quarter and is up 17.9% year to date. So the reason for the international outperformance we noted in the first quarter has continued, which has been primarily driven by the decline in the US dollar and strong growth, particularly in Eurozone companies. The one-year international equity return is now 3% higher than US equities. An interesting fact, Joe, That I recently read in a report that was published by one of our managers, Neuberger Berman, that between the years of 2010 and 2022, European stocks lagged as U.S. companies increased earnings by 14% per year, compared to just 2% per year for the European shares. No surprise here, right? But this script has now flipped. Since the fourth quarter of 2022, European companies have increased earnings by 12% per year versus just 5% for US companies. So with this said, we are just seeing some steady growth out of Europe, which definitely makes the case to keep your equities diversified between US and non-US, despite years of US outperformance.
That's a great fun fact, and now I have one for you. So in the last 15 years, the MSCI ACWI, or that's the All Country World Index, has only outperformed the S&P 500 one time. That was back in 2017. So this rotation from U.S. to international is worth watching closely. Much of it still depends on the dollar, but also on how this Magnificent Seven deliver on high growth expectations, because their weight in global portfolios remains quite high, and their valuations leave little room for earnings disappointment. So all these things considered, how did the Wespath equity funds perform this quarter?
So starting with the U.S. equity fund, the fund returned just over 8% net of all fees for the quarter, but underperformed the Russell 3000. The underperformance largely stemmed from the fund's underweight to mega cap stocks, especially the Russell Top 50. The fund does invest in mega cap stocks, but our fund is underweight these names by 19% relative to the fund's benchmark. Earlier in the year, we saw mega cap stocks, specifically the Magnificent Seven, hit negatively after the DeepSeek AI development in China, which sparked a rotation out of US tech. That rotation was short-lived, and we saw a sharp rebound in the month of May. I also want to point out that our US equity index fund on this slide. This fund is constructed to track the Russell 3000 index, so it's a broad-based US equity fund that has allocations to large cap, mid cap, and small cap US stocks.
Yeah, before we move on to another interesting tidbit, tech company performance in the US has been very strong over the past 2.5 years, and only roughly 35% of active managers have outperformed their benchmarks in this period, which leads us to believe that most active equity fund managers have been underweight these tech names due to their high valuations relative to other segments of the market. With this being said, at Wespath, we're doing a lot of work and analysis on our US equity fund. We're excited for what the future brings for this portfolio, and we look forward to discussing that with clients in reviews and in future webinars. Karen, how about the International Equity Fund?
The International Equity Fund underperformed the MSCI ACWI ex-US for the quarter and year to date. So unlike our US equity fund, there's no Wespath specific tilt or bias in this fund. So the underperformance came from both stock and sector selection. Stock selection in industrials, specifically by not owning aerospace and defense, which those stocks were up 30% for the quarter and 76% year to date, was a detractor to the fund performance. That said, the fund was up 11.2% in the quarter and 15.4% year to date. So while it lagged the benchmark, it still delivered strong absolute returns.
Okay, so before moving on to fixed income, let's also just quickly touch on the Social Values Choice Equity Fund. This fund continues to see strong interest from institutional investors. The fund is measured against and tracks the MSCI World Index. So unlike the International Equity Fund, it excludes emerging markets. The fund is about 72% invested in the US and 28% invested in international developed countries. It is passively managed and with additional screens on fossil fuels and human rights. The second quarter performance was 11.7%, which is slightly ahead of the benchmark, and year to date, it's at 9.9%, slightly ahead of the 9.5% for the benchmark. Now let's move on to fixed income. How did the quarter or the events in the quarter drive returns?
Bonds posted positive gains for the quarter and year to date, despite all this noise that we saw. The Bloomberg US aggregate was up 1.2% in the second quarter and 4% year to date. The Bloomberg Global aggregate rose 4.5% in the quarter and 7.2% year to date, helped by that dollar weakness, which boosted non-dollar bond returns.
And what about the Wespath Fixed Income Fund?
The fund outperformed by 80 basis points in the second quarter. Roughly 10% of the fund is invested in non-dollar bonds, which contributed to the performance as we saw the US dollar decline by roughly 10%. With this said, the biggest gains came from the emerging market bonds, followed by developed market debt, which was primarily from the currency FX.
And what about the Inflation Protection Fund?
The Inflation Protection Fund beat its benchmark by 109 basis points in the quarter and slightly ahead year to date at 4.8%. The top contributors included emerging market inflation-linked bonds, which were up 9%, and allocations to developed market inflation-linked bonds, bank loans, and diversifying alternative strategies.
Great. Thank you for that update, Karen. This wraps up our market and fund performance for the second quarter. As always, thank you for your trust and your partnership. We'll continue monitoring developments closely and look forward to discussing more in the next quarterly reviews.
Thanks again, everyone, and please reach out if you have any questions, and we'll see you next quarter.